Welcome to the Keys to Getting Venture Funding. We've got a really great panel with us, led by Rachel Kemp, who's our moderator. She's VP of Pickwick Capital Partners. Kerry Leppo, President of Transcendent Aerospace. Larry Genovesi, CTO of Embue. Sean Reilly, who is Managing Principal of Rath Capital Partners. And boy, we were really privileged to get these folks on this panel. They all have great experience, just deep experience. Rachel is an investment banker and managerial and financial expert. Kerry as an entrepreneur and operating executive and former M&A and PE investment banker. Larry has been a serial entrepreneur and has taken a lot of companies, two companies to IPO and started and led 5 companies. And Sean Reilly is a venture fund and investment advisor and former private equity CEO. So these are the kind of people you want on a panel like this. And I'm thrilled to have them here. And Rachel is moderating today. So I want to turn it over to Rachel and get the discussion going. Rachel, take it away.
Thank you, Mark. Such lovely introductions you did for all of us. So tonight we're going to talk a little bit about venture capital. It's that sexy, elusive investment opportunity. And I should really ask Kerry, because he's first up, what do we really know about venture capital investments and where do they sit in the capital stack?
You can only take it from my perspective, but I come into this actually from private equity. So I look at the venture capitalists doing much bigger deals. A lot of the deals that we were involved in are middle market deals, so $5 to $50 million smaller. And I've always run into more private equity in the startups that I have been involved with. Venture seems to sit right at the top, though, when you're doing a large raise, and anybody's free to correct me if I'm wrong, but when you get into needing multiple rounds of funding, in stages, the venture market seems to be much more willing to do those things, whereas the angel private equity folks are a little bit more focused on quicker returns and sometimes less time in the deals. So I think they're sort of the big dogs if you want to talk about money, in my opinion.
Okay. So one of the emerging trends that we have seen are these seed venture capital funds that are very targeted either on an industry or a sector basis. And they will sometimes do deals as small as 500,000. But these venture capitalists are far and few between because, as you said, they're looking for the big deal.
True.
Yeah. So, Larry, now that we're beginning to exit the pandemic, are you seeing any trends emerging in the market since we all know now that you're looking for capital?
Sure. So there's been a couple of big things that we're seeing. So first of all, as you can imagine, energy is hot. Keeping carbon out of the atmosphere, keeping trash out of the landfill, whatever way you want to look at it, those are the big deals. And now all of a sudden, clean tech 2.0 is coming. Now, the big problem was for us people that have been around long enough, clean tech 1.0 was a huge catastrophe. So a lot of people put a lot of money into deals with kind of not much understanding of the technology and the amount of money and time it was going to take to get proper returns. And that really soured that, sort of that market. So that if you a year and a half ago, if you were trying to do a clean tech raise, it was really difficult. Now all of a sudden, everybody's interested in this. Obviously, the Biden administration has put a lot of money and resource behind this. I think it's good, and we're starting to see that happen. The big problem we're seeing now, and I just so happen to have a startup that does building energy management, energy efficiency, and things like that, is that The new money doesn't understand the technology in the market. So I think there's going to be a period of time where this new money is going to chase deals, but not quite understand what the criteria is for a good investment. And my fear is that we may end up with a lot of failed deals. My hope is that at least some of them learn something from the first time around on this, and will be smarter about how they invest their money. Okay.
So give us a little bit more of a definition of what you're calling a failed deal, just so everyone.
So you've got deals where you've invested, as an example, in exotic technology. So it's a new type of heat pump, or a new type of freon for compressors, or a new type of solar cell, and these require deep science, right? And deep science takes time. It's the industry that does this really well is biotech, right? So they get it. It's going to take years and years and years to develop and test and get a drug through trial, and they invest in that way. The clean tech original investments weren't done that way. They were done more traditionally as a market opportunity, thinking that the amount of time to get to a solution was going to be reasonable. And it wasn't. And then some of the deals were things like A123 and some of the solar panel companies, where the market was wiped out by all that technology manufacturing being moved to Asia. So all those companies failed because the market went away and the prices dropped. So I think all markets have their complexities. I've done many of the deals I've done have been in enterprise systems, and those venture capitalists were very knowledgeable about those technologies, understood the risk, understood the reward, understood the market, maturity rates and things like that. I don't think that happened originally in clean tech, and I'm not sure it's happening that much now, but I think that you've got some older venture capital firms with a lot of wisdom who are starting to look at investing in clean tech. And I think that's good, because they will be rigorous about what they invest in.
Okay. Thank you. Thank you. So in the last time this group got together, we listened to a pitch competition. And to secure a management call with a venture capitalist, the pitch book has to strike the right tone. So, Sean, I don't want you to think that I forgot you, but could you talk a little bit about what venture capitalists are looking for in the pitch book?
Absolutely. And two things are glaring to us as we look at thousands of pitches a year. First is keep it simple. There's always this idea that because you're looking to get millions in funding, or even $500,000, say it's a small micro project, it needs to be a very robust and long and drawn out pitch deck. Keep it simple. We want to see what you do, why you do it, what the market is, what you need capital for, and how you plan on spending it, and really what does the future look like, knowing, of course, that nobody has a crystal ball. The second thing, and it's really a 1B versus a 1A, pitch to us in your own voice. There are templates you can get. There are advisors you can hire. There's a myriad of different places you can go to help you write a pitch deck. But we want to hear your passion come through in your pitch deck. As a VC, there's two things we look for investing in a company, particularly my firm. Strength of management team, which includes very much so passion. We want to know that you're passionate about what you're doing. And secondly, obviously, return on investment. If you give us a pitch and it's not simple, it's convoluted, and we can't hear your voice, we can't hear your passion come out, we're not going to be interested. And it might be a hell of an idea that you have, or a company that you're envisioning. We have to hear it from the founders. I had a pitch deck last year that was 140 pages long, and I'm a pretty good reader. I got through 10 pages. They inserted the constitutional code that allowed them in this particular state to do this type of business. It was a little bit unwieldy. Keep it simple and give us your voice. That's what we want. We want to hear your passion.
Great, great. You actually answered my next question, which was, what are the VCs looking for in the management team? So passion, keeping it simple, making it understandable, those are all the keys to a successful pitch. So Mark, I can turn things back over to you at this time.
So does anyone have any questions for our panel? We've had a number of people join in the last few minutes. We've had a really interesting discussion to kick things off. If you have a question, just shout it out and let's keep the discussion going. I know Paul Hare probably has a question.
Oh, Mark, you are good. You are good. Always, and so on. So, there's this age-old dilemma of, sort of magic numbers. On to your point that you don't want to pitch a 150 slide pitch, but there's always this sort of trade-off between presenting the idea sufficiently and keeping it very short and letting investors sort of guide you with questions. Do you have a rough sense? If you see something more than a 10-slide deck, is that a death knell, or is there a little more magic? Would you mind elaborating around that? I think that's creating that right pitch deck is where a lot of entrepreneurs spend a lot of time and often miss the mark.
Yeah, that's a good question. I've seen formulas that, the 10-minute, 20-minute, where the pitch is 10 minutes long and the question and answer is 20 minutes. We like to do about a 40-minute pitch with about 15 minutes for questions from us and about a 15 or 20-minute pitch from the entrepreneur. I'm being very general because you can get into some technical projects, but I think the misunderstanding a lot of entrepreneurs have is that the pitch is their only shot that they have to get in front of the VCs. And we look at it as the beginning. We want to get excited about what you're doing. So frankly, we can have an hour with you, maybe a week or two later, and start really putting holes in your financials and asking some very pointed questions. But if you can't give me your passion in 15 or 20 minutes, then I'll never say it's a hard no, but it's going to be, you should be able to do that very quickly and very succinctly, I think. Is there a formula? No, but that's what we generally use.
Yeah, Kerry, you and I have talked about similar things. You probably have a reaction to this.
Yeah, there's no set number, but I tell you what, the last two companies I started and raised money for, my decks were 11 pages. Great financials, great pro formas to back it up, but you really have to connect. First of all, you want to tailor your deck to the person that you're presenting to. It's not a one size fits all. There is not one pitch deck. I think the last company where it was probably 11 different pitch decks, depending on who we were talking to, and the knowledge base that person has. It's best to do a little homework on the company you're presenting to. So you tweak it to the folks you want to keep it to. You make a connection as a human. I second what Sean said. It is so important to communicate your passion for the product, and don't sit there like you're in Ferris Bueller's class with Bueller type of presentation, because you're going no place. It's really good to connect, and it's really good to be succinct and just have a good set of financials. And the financials need to back up your passion. And the more experience you have or more successes you've had in the past is also a pretty good predictor of how people are going to look at your management going forward. So, you don't want to come in with 6 failures. Though if your 7th one is unbelievable, you'll probably get picked up, but make sure your management team is rock solid.
And maybe if I could, a quick follow on, what are your thoughts on where are folks, generally putting money today in terms of stages? There used to be, a good idea and a business plan could get you funded. It seems to be that, from a risk profile standpoint, I get asked a lot of questions when I've gone to pitch recently, who are your customers and how much revenue do you have? And those typically weren't questions that were asked to, a business plan startup. So, where's the prevailing wisdom on where, what the investment climate is and where companies need to be at even these very early stages? Or, maybe asked a different way, how much of the market needs to be de-risked by the time you would be willing to invest?
From our perspective, we like to see you have either close to, we typically don't fund startups, but we'd like to see you close to revenue if you're not generating revenue. Our funds and our firm is very much what we like to say is an accelerator. We're going to get your rocket fueled up and get you from point A to point B. We're going to get you from Earth to Mars. We just need to make sure, A, you have a rocket, and B, it's actually pointed at Mars. Because when we take the thing off and we miss Mars, we're going to end up in a sad state for all of us. But the point's valid. It's that we want to make sure that you're either generating revenue or are close to revenue, and that we're going to accelerate you from point A to point B. You just got to know what those 2 points are, or have a good idea of what your market is. The other thing too I want to add is be realistic about some of the projections you put in the pitch. I saw one the other day that said our target market is $187 billion. Well, that's not the target market. That is the market. And we want you to be real about your numbers. If your numbers are we're going to go after $7 million, then tell us that. We want to appreciate who you're going after and why. Don't tell us what the universe is, because we're not landing on the universe. We're landing on Mars. And it's important to be able to articulate that and for us to understand who actually is your customer.
I have to agree with you, Sean. We're in market every day looking at different opportunities, talking to different VC funds, PE funds, and they're all looking for that visibility to revenue and the reasonableness of your first year target numbers. If those are not reasonable, the deal is dead. There's no more conversation. And we've had to have that very hard conversation with our clients around just being reasonable. Don't try to sell the world, because you're not going to get there, particularly in year one. So absolutely on point.
Yep. Larry, you looked like you were going to say something a minute ago.
Yeah, so I've been raising money a long time, and it's true. It's changed a lot. I mean, when I first started, you wrote a really good business plan, you figured out the market, you pitched it, you got $5 million to create a technology, you sold a few, then you went to your B round to get rocket fuel. My current company, we've personally put $4 million into it on our own. We've built a product, we have customers, we have a distribution channel, and we're out looking at seed rounds and A rounds now. So it's very different world now. Angel investing has made a real comeback because venture capitals have moved up market. They don't want to incubate early stage companies in general because it just takes them too long to get to an exit. So I think that you got to bear that in mind, and it depends on your company. If you have a company where you want to make the next great social media app, and you can do it with 3 people in your basement with a microwave and some hot pockets, then great. I mean, I used to make fun of that, but now there's all these social media billionaires, so I guess I was wrong. But it's different if your company needs to do something complex. And you need to be ready to understand that, and your funding sources have to match that. So if you need to create enterprise technology or new chemistry or something like that, then that's a different kind of raise. And sometimes those are better done with partners. So you can find somebody maybe interested in your idea, wants to fund your development work. That could be a great path. But the other point that I was originally going to make was about the passion thing, and it is so important because I've done a lot of due diligence work for venture capital firms over the years, and it's really kind of sad to see somebody who has passion but doesn't show it. And it's really hard for venture capitalists to get excited. And I tell people all the time that if you're the CEO of a company, your job is to be the chief storyteller. You're telling the story to venture capitalists. You're telling the story to your employees. You're telling the story to your customer. You've got to get them excited about what you're doing and why they don't want to miss it. And, a very famous and successful venture capitalist once told me, he said, the only thing worse than investing in a bad deal is missing a good deal. And he said, you get to invest in the good deals when you find the people with the passion.
Yeah, and it kind of brings up, Rachel, what we discussed as we were prepping for this, that there is a venture capital stack. And could you kind of go into that concept?
Sure. What we've found in the market recently is that venture capitalists are sort of parsing themselves out. There are the micros, the seeds, and then there are the big boys. And it really takes some effort on the part of the entrepreneur to find the appropriate capital that will look at them at the stage that they are on that corporate development curve. That's a very important thing, that you have to match where you are on the curve with the money that you're seeking. And then bring a good deck, bring your passion, and hopefully something happens.
Yep. And we do have a question from C. Henriksen. You mentioned several busy markets, including clean tech, in a crowded space, such as COVID solutions or energy solutions. What are your viewpoints on the best way to cut through the noise? And I guess that applies to just about anybody who wants to pitch their business. How do you cut through the noise? Larry?
Yeah, I mean, it's a good question. I was just thinking about it. It's so, my company is an example. We pivoted, right? We tried to be to the smart home market and found we couldn't do there. So we went out and we started looking for things that were related, but where there was virtually no competition. And we did. We found a greenfield market. So that market was crowded. In fact, we pivoted right about the time Google bought Nest. So we figured that market's over, right? We're not gonna be the next Nest. But we had all this expertise and technologies, and so we went looking for a related market, and we found one. So I think that part of it is the hardest problem as an entrepreneur is that you drink your own Kool-Aid. So you believe that your first idea is your best idea and that it's going to succeed, but you have to be super critical about that, and you have to look at it from a marketing standpoint. And, and I've had some great marketing VPs, and they've all basically spent most of their lives telling me, no, it may be a good idea, but nobody wants to buy it. So you have to look at it from the standpoint of what is the market telling you that they need, and is the market open enough and early enough that you can make an impact in that market. So even in a crowded market, a good idea that people want can survive, but you need to do the critical thinking and research before you get in front of the venture capitalists to make sure that you can prove to them that the market isn't overcrowded and that you're early enough in and you have a solution that will garner a significant percentage of that emerging market.
So to echo your comments, Larry, you're saying bring pragmatism, do your own due diligence, make sure that your market can support itself and support you, and the expectations on the return on investment that you will need to match your cost of capital.
Exactly it. I mean, I had one startup where we had a brilliant idea. The market needed it, except we were 3 years too early. Yeah. And we didn't succeed, right? And eventually somebody did succeed with our idea, but because they timed it properly in the market. So market timing is everything for success in startups.
I think to Larry's point too is, as an entrepreneur, you have to know your why. What are you trying to do, and why are you trying to do it? And as I mentioned, Larry's point, it doesn't necessarily matter. You need to be flexible and able to pivot, but you still should be able to solve that why. So understand what you're trying to do, what you're trying to fix, what you're trying to create, and what market you're in that you're competing with or you have a focus on, and understanding that need. But you need to be, I always tell entrepreneurs, you need to be flexible. Just because it's in your pitch deck does not mean that's what you're going to end up with at the end. So you need to be able to pivot. And I actually am not a big believer in that word, but you need to be flexible and still be able to achieve your why. Maybe not with version 1.0, but maybe 1.5 or 2.0, you can still probably be just successful. And I would argue probably more so by being that flexible.
Yeah. John Weaver is sitting in the lobby of MBI right now and has a question.
I'm actually watching 3 kids, so if you hear screaming or you see me go off screen, you call the police. But Thanks everybody for jumping on the panel. This is great. And MBI has 58 early stage life science companies in the market. I was just curious on Larry's comment. We keep hearing how there's a ton of capital flowing in the market. Curious what your input is on how long that's going to last and how important it is for entrepreneurs to get that while it's flowing.
Well, I mean, you obviously got to get money when you can get it, right? So so you got to strike fast. I don't really know. I know a lot of venture capitalists, and I've asked them all that question, and all of them are giving me vastly different answers. So I think the interesting thing about the clean tech market right now is that there is going to be a lot of demand, and I think that's going to drive investment. But I think part of it's going to be driven by, are there going to be some early successes? And I think if there are, that will drive more money into the market. But almost every major fund that I pretty much have been in contact with or dealt with or have had investments with have started up some sort of clean tech fund. And many of them right now are small. So they're going into doing seed rounds and things like that, which shows me some level of caution on their part, which is, I think, a good sign. So I think that market's going to run long. But I think that, my son-in-law manages a very large fund, and I ask him about what he thinks the market's going to do, and he looks at it and he says, "Don't tell any of my customers, but I have no idea." So I'll give you my best estimate and guess, and I'll give you a bunch of good math behind it. But he said, right now, who knows? And if the economy, I think, continues to build and it recovers and it goes well, then I think venture capital has got a pretty bright future.
I think that from my perspective, there is definitely a larger group of unicorn hunters looking for bigger projects. And this will sound interesting. You have the PE or the angel or startup rounds that are, say, $500,000 to maybe up to 3 million. And then, 3.5 million, or I should say the next venture round could be 15 to 20 million a project. Well, in that small, tiny little gap that is huge of $3.5 to $15 million per project, you have very innovative, very revenue capable companies that are being started or even going through the first or second rounds that are very profitable and offer great return. So I know my firm looks for that, dare I say, a niche, even though it's as wide as the Grand Canyon, those niche of companies. And frankly, as a VC in the industry, we want to always diversify that portfolio. So if we have, we can put it in an Uber and a Lyft, or we can put it in 10 smaller investments that will probably outperform those bigger investments, at least in a shorter period of time. We'll look for those as well. So there's definitely a lot of opportunity out there. And I think as we roll out of the pandemic, there's going to be some profit taking out of the equity markets, and it's going to be put into the private VC markets. That's at least my take on it.
Paul, I see you've got your hand up, but I wanted to get Ife's point of view on what he's seeing. As he came in second in the 5-minute pitch contest, and I'm just wondering, Ife, whether you have any thoughts or any questions regarding raising funds.
Yeah, thank you all for this discussion. It's really insightful. My ventures in the sort of the social impact kind of space. I know it's something that we've sort of can make some tangential connection with from climate change. And one of the areas that I'm trying to focus on is how to pitch to investors, certainly who care a lot about the profit, but also may have that other need to see outcomes that can contribute to the kind of impact that we care about. So I think for me that the stories about messaging, about narrative, all resonates, but it's on top of that, I'm still thinking about how what's the appetite, right, for ventures that do sort of fall in the social impact space and are trying to find ways to communicate the value that sometimes goes beyond just the financial return.
I don't think it does. I remember your pitch well. And I think the issue is your passion was exactly what everybody wants to see. The way you presented and what you have is a very great thing. What I think was lacking there was I talk about your pro forma has to be really good. And Sean mentioned you've got to be, inside of revenue or inside of coming to the market. You can't be too early, and you have a couple of different paths in order to get people to join your group to generate revenue. And I remember your revenue number being 5 years out almost. Did I remember seeing that? You were talking about getting to like 500,000 in revenue almost 5 years out. Was that true?
Yeah, that's really good memory. That's correct. 500,000.
Okay. Your presentation stuck with me pretty well. The problem with going out and presenting, your presentation was great, your deck was good, but the revenue model, people come up with hockey sticks, and that's really just as bad as having a very far out, target. And Sean might want to address that as to how far away you are from revenue, because that matters for every investor, not just VC, but an angel or everybody. Never mind, if it's a social impact kind of company or whatever, everybody still at the end of the day invests to get a return. So that's what you have to make sure is tightened up, is generating revenue as soon as you can, and as soon as it's possible. Does that make sense?
Yeah, and to Kerry's point, it's not, as a fund manager, I serve two purposes. I invest in companies to get a return for the fund. Well, what does that mean? That means my other job, I'm out begging investors for money. So I'm begging for money all the time. And when I do that, that investment that they make to us has a time limit on it. Our funds are 10 years old, which means we invest from years, money brought in year 0 to say year 2, 2.5. We're going to let those kind of cook for 2.5 to about 7, and then we're going to start harvesting. So when we look at projects, we're not overly concerned necessarily, but about how much the revenue is in your company, but how quickly or how far away from it you are. I mean, frankly, if managing funds, it's very difficult for us. $500,000 is over a few years is while it's a good scale maybe in your particular market, for me to provide return back to the fund, which in turn goes back to the investors, I have to look at other very creative and aggressive investments to almost make that up. So we're not all the evil people, although our industry deserves a lot of that. We're very much on a time clock ourselves, and we have 10 years, which seems like a long period of time. And trust me, I thought it was too, until you start getting money and then you're like, wow, we got to turn this around pretty quick. So that's really the genesis of kind of what Kerry was saying. We have a clock ticking on our back as well.
Yep.
Yeah. So we've got two questions. We've got Paul Hare has a question, and I just, this kind of relates to what you were just talking about, Sean. Jeff Brown asks, how do venture firms raise those funds? So when you're out begging, how do you do that? And do those investors have a role in the decision making on which companies to invest in or which sectors to invest in?
That's a very good question. So one of the reasons why I talk about passion and how you make concise pitches is that when I'm out begging for money, I'm doing the exact same thing. I don't tell my investors this, but I'm an entrepreneur first. I have to make myself special. I mean, I don't know how many VC firms there are, but if there's one more than me, that means I have a competitor. So I have to be special. I have to be passionate. I have to talk about why we do it differently and what we're doing differently. And a lot of that goes to, as I was talking about, those smaller investments. A typical VC portfolio, projects 1 and 2, 500 times, 700 times. But 3 through 10 are complete failures. They're zeros or negatives. With our portfolio, projects 1 through 12 in our first fund all return positive returns. That's what makes us a little bit different. And then in terms of what was the second part of your question? I get so excited about the first part, I forgot the second part.
Whether those investors, the people who have given you money, have any input or say in the companies you invest in.
So in our case, we stress limited partner in our funds. We want to make sure that they participate in the success of the fund, but in our agreement, we spell it out that they don't have input to what we invest in, how we invest it, the deal structure, any of that. That creates a very active cap table for your fund. And I would argue if you're investing in my fund, but you're relying on yourself to direct where it's going, my function as your VC and fund manager is diminished. So I would argue you should put it with someone else. You're giving me your investment because you trust me to make those types of investments and to understand where they go, what the structure should be and all that. So we like to keep the cap table a little quieter. I think it makes life a lot easier for everybody.
There are VC firms that use what we'll call third-party marketers. And those folks actually go out and identify the limited partners on behalf of the GPs. And when we're talking about this entrepreneurial spirit, that comes into play because then the VC firm is acting very much like the entrepreneur, having to come in, pitch, differentiate themselves, and may have to satisfy criteria on the front end in order to access that money. And, I watch approximately 44 third-party marketers every day go out and be very aggressive in identifying new sources of funds, going back to old funds and saying, but we did this for you on the first go round, you should participate with us again.
Paul always has great questions. I want to go back to you. You had your hand raised.
Too kind. Well, it's an interesting theme that we've sort of flirted with a little bit here. In fact, Rachel, I want to come back to a specific insight that you mentioned, which is your first year revenues need to be realistic. And that's interesting. But, Kerry, you said the age-old hockey stick, right? That's what every entrepreneur puts forward. And we have heard, by the way, that this is a double-edged sword. If you're not optimistic enough, you're going to undersell the idea because, again, you've heard this on this call that the investors are after a return. So they want to see that their money's going to grow. So there's this balance between what you think you can accomplish in the short run versus what you think the opportunities are very quickly thereafter. And I think this is a theme that we've heard from all of our panelists, which is you got to be close to revenue. You got to have a path to get that revenue, but then you have to have a path to get a lot more revenue after that. So, comment if you would on this hockey stick phenomenon. If you don't have it, are you out of the game? And then how do you temper that, Rachel? I mean, do you need to show a first year realistic number, but then a serious hockey stick thereafter, to be credible? What's prevailing wisdom these days?
I don't think that you actually need the hockey stick. You need to have reasonable numbers to get you out of the gate. And then your go-to-market strategies should be pragmatic enough that they can be understood by whomever you're pitching to. And there's a reasonable scalability to the numbers. My experience is that a lot of venture capitalists, PE firms, they're afraid of the hockey stick. And they would rather see reasonable first year numbers, understand your go-to-market strategy, and then how are you going to really scale? Where's the return for them? Where's the opportunity? And that's what they're looking for. Not we're here today and then we're way up here, because there's too much of a gap. There's too many what ifs that have to be responded to.
But there are industries, though. There are things that hockey sticks are very possible. I mean, an app, for example, is just one of those things that if it gets the right PR, it goes from 10 downloads to 1 million in a couple of months. So you do get a hockey stick once in a while. It really kind of depends on your industry. Like you say, the biosciences are a much longer time. It's a very slow ramp up, and then it may just go once your product is ready. It could hockey stick at the end, or you get the end of the blade, rather than the shaft, so to speak.
Well, I would agree with the industry's perspective. Those that are SaaS models, high recurring revenues, anything that is a hyphenated as a solution, those all have the ability to ramp and to ramp quickly.
Yep.
But we're trying to give pragmatic advice. And even though there are those exceptions to the rule, they are exceptions to the rule.
There's a different way of looking at that. This also is that, one of the detriments of business planning is the spreadsheet, right? Because anything's possible. You just tweak a number and all of a sudden, you can be growing at exponential rates. But sometimes I find the way that I've done it is that you understand your market, and then you understand your go-to-market strategy. Right? I mean, in all the pitches I've done in my career, very few venture capitalists have really asked me how the technology works. They've asked me, how do you plan to go to market? How are you going to get there?
Right.
And so
that's right.
Think about that, right? The growth is a function of that. So, I mean, in my experience, my current company, we figured out we're going to use partners, and we find partners that have a unique set of skills that get us to the places that we want to go. And we talk to them about their productivity rate and how long does it take for them to, come, to bring a new partner like us on in their strategies. And so from that, we can synthesize a pretty good growth rate, actually, as it turns out. But when we get that question from venture capitalists, we have an answer. We can say, no, we didn't just make it up in a spreadsheet. This is what we did. We thought this through. We talked to our potential partners. We've got some customers, and we've been able to, at least on a reasonable scale, prove that our assumptions look correct. And in the end, they don't care what that, what they care about is, all right, the chances of success for that are good. It's well understood, well planned, and well implemented.
We want to know two things. We want to know, when we look at the spreadsheet and the potential growth, we want to know how you can explain that. How do you account for that huge hockey stick? If you can, and that's realistic, then that's good. But you need to be able to explain the numbers. I had one just a couple of weeks ago on a spreadsheet that said year one, they're going to do 5 million. Year two, they're going to do 40 million, and their marketing budget's going to stay at 150,000. It's like, well, okay, I'm not a marketer, but you must have a really good cost-effective way of doing that, because that doesn't make any sense to me. So it has to be explainable. It has to be real. We're much more interested in investing in your company if your numbers are real. Nobody thinks that the 5-year projection is going to be real, but going from year one to year two should be close if you know your market and you know how you're going to go make that hockey stick stand up.
Yeah. I saw one come in from Jason Julian. I see you've got your camera on, Jason. Do you want to ask your question?
Sure. I think I'm off mute now. I operate a lot in the medical device space, and there's really interesting activities due to COVID with the EUA authorization from the FDA, and I've been exposed to some craziness in investing for that. If any of the panelists, do they have anything to add about the EUA activities and investments, such as when they see it ending, or when do they see a trend that there's going to be a large shift of investments to those EUA authorized products that are going to need FDA clearance at some point in time?
Not my area.
No, not mine either.
That's not my area either, but the only advice that I would give is to understand the market, and that includes the input the government has. If it's anything EU or anything emergency, you know that has shelf life and it's going to end. So what does your product or service look like in, dare I say, normal conditions, and how profitable can you be? I think it's great to capitalize on a market that's under a special circumstance, but I think you have to play the long game and understand what is the impact going to be when it rolls out of whatever that special circumstance is.
Eric Swanson asks, and I think this is relevant to the discussion we had just a few minutes ago, how detailed should financial projections be? Obviously, just putting an arbitrary hockey stick on there, or saying you're going to spend $150,000 on marketing and be, a multi-million-dollar company are just lines from a spreadsheet. So how detailed should those projections be? Sean, you'd probably be the best one to answer this right off the bat.
So the safest answer is not that detailed and then very detailed. And what do I mean by that? In your pitch deck, talk about how much you need and where it's going to go to. But I beg people, please don't put your cable and internet bill on a use of funds document in a pitch deck. Like, I don't need to see that level of detail. I just need to see how much you need and what you think it's going to go to, and maybe some ideas around structure of a deal that you'd be interested in. We will get to due diligence if we're interested in the idea and understand your passion and your why, and we will go through how much your cable bill is and what that rolls up to. So you have to have it, and you have to have it ready, but it's not something that takes up a full page in a pitch deck. We don't care. Use of funds is not down to the penny, honest to God. If you stay around $100,000 per use, that's okay by us. We just want to understand what you want to do and what it's going to cost in general.
Awesome.
I have one other related follow-up to that sort of kind of tails along on that. People get really detailed in their financials. What also happens is they know the technology and they want everybody to embrace it. And a lot of times you look at a technology and it's going to be a given and they want to know how you're going to get to market. So don't get bogged down in a presentation or a pitch deck with the technology down to the nth degree, because they want to know that they're going to say, okay, during due diligence, we're going to figure out whether that product works or not. But we want to be excited that we seem that it works and it's ready to go to market today or really soon. I think that's more exciting for a guy like Sean.
All right, guys, just one more question that we get a lot from our entrepreneurs, which is, a lot of times when companies are started by a really technical CEO, first-time entrepreneur, they really need to build out their management team. But to do that early on is tough because the really talented people can do 100 different things. So any suggestions for first-time entrepreneurs in helping build out that first management team, particularly when a lot of times that CEO is going to get replaced in a later round anyways?
John, I'm going to jump in on that one. Yeah, it is not to rush to venture capital. There's so many informal sources of capital available to early stage teams that it buys them the time to get credible, whether it's management, finishing prototypes, early contact with the market. All those things can happen before you encounter that very firm interrogation that comes with venture capital. So I teach this at WPI, and I'm astonished at how quickly we run to the wrong source of capital. So SBIR grants, there's so many ways that you can raise capital along the way before you encounter the rigor of a venture investment.
Just to add to Jerry's point too, venture capital is great until you get it. It creates a lot of downward pressure on the entrepreneur to perform. And you need, I was just saying in our breakout room, just as the entrepreneur has to be a good fit for us, the VC, we have to be a good fit non-financially to you as well. Because once that wire or a check gets cashed, the time is ticking and there's a lot of downward pressure, and it puts a lot of pressure on the management team for scope creep to want to do other things that might not be on the project list. So, well, now we can do this or we can go this way. And it's hard to keep everybody focused. So you need to Jerry's point, it needs to be at the right time. And that's something that you work out with your VC partners.
Sean, I agree entirely. When I built my company, one of the lead investor was a key member of our board of directors. We went to him for advice, direction, well before we encountered financial transactions. And he was an incredibly deep player for us. So yeah, there's lots of roles that can be played.
I think it's also important to reach out to the resources that are around you, like Venture Forum. And I'm also the executive director of Work Lab in Worcester, and we're an incubator. And in fact, we're partnering with Venture Forum, which is really exciting. So we're, going to have a lot of resources for new entrepreneurs. So you'll be able to get a lot of this gray hair advice, as I like to call it, from many teams, and also have places where you can, start your company, hang out with other entrepreneurs, talk about different issues, talk to people with experience in all aspects of starting a business. So you should definitely reach out to those organizations, and that will increase your odds of being successful, in my opinion.
Another thing, Allison brings up a great point, and it's mentors. You know, there's nothing like a mentor who has been there. Like if I were starting a company, I'd want Larry to help me, figure out those steps between the idea and making it all real, because he's been there. So finding someone who has done that is great. And the Venture Forum is starting a mentorship program, and we kind of have already started it. We did it with the 5-minute pitch contest, and those mentor-mentee relationships between January and March transformed how those entrepreneurs pitched their companies, how they thought about their companies. It was startling to see, but not surprising when you think about it, because they worked very hard with those people. So finding a mentor can be a bridge to that information we were just talking about. When do you go and raise money? Well, the mentor can probably help you with that and point you in the right direction, instead of just thinking, well, I want to go to Silicon Valley and raise, $100 million right off the bat. That's not the course of action for most companies.
Look how successful MIT's venture mentoring service is. They've been sold out for years.
Yeah.
They're running at capacity. Yeah.
A lot, all the time.
Yeah.
Can I follow up on something in the breakout room that we were discussing with Mr. Hendricks in there? You were talking about developing a product, and I guess your company could be at the point whether you have to decide whether you want to be a business or an enabling technology. Sometimes you don't want to reinvent the wheel and become a manufacturer of an air cleaner, even though your technology is whiz bang. And that's where you look for a joint venture partner for your company and let them take it to market and be the enabling technology. And sometimes that's a smarter route than, banging your head against the wall, trying to raise money, reinvent the wheel, build a factory, yada, yada, all that stuff that isn't necessary, where you can make a boatload of dough just licensing it.
Exactly.
So, yeah.
Excellent idea.
You can license your technology. Look how much money you can make just by having someone else run with it.
Mm-hmm.
So I think that's my job as an academic, is to lean on alternatives, so that if by the time they're ready for the encounter with venture capital, they're best prepared. And and it goes to your point, Sean, if you have to coach somebody all the way along how to deal with you guys, it's probably a misfit to start with.
It's like any other relationship. It shouldn't be that much work.
Yeah. And the best way to interact with the Venture Forums, drop me an email, Mark, M-A-R-K, at theventureforum.org. And I'd love to learn about, what you're up to and what your needs are, and maybe have a conversation. I appreciate your questions, everyone, and I really want to thank Sean, Larry, Rachel, and Kerry for being on the panel. It certainly exceeded my expectations, and this has been absolutely wonderful. It's been a great hour or so spent, and I can smell dinner cooking downstairs. So I think that's going to be my next stop.
Likewise.
Thanks so much, everyone, and
thank you.
Really appreciate it.
It's a pleasure.
My pleasure.
Well done.
Yeah, my pleasure.
Well done.
Pleasure.
Bye, everyone.
And we'll
Cheers,
see
everybody.
We'll post a recording of this too. So
Great.
Sounds good.
Excellent.
Thanks. Bye-bye.
Thank you.
Bye-bye.
Thanks, guys.
Everybody.
Appreciate it.
Thank you.